we really underperformed the region. In fact, Japan managed a positive performance. Korea looked flat. We saw China down by about 0.5%, but the Australian market down by 1.3%. And I guess it's because we were relatively unscathed last week. Now, last week was a big week for the US stock market. We saw the Nasdaq down by about 3%. We have a look at the Japanese market. It was absolutely slammed, down by 7%. Even the London FTSE was down by 2%. But in comparison, the Australian market actually managed to gain 0.1%. So it looks like now we are playing catch up. A lot of the views are that we are going to see a bit of a deeper correction, 5 to 10%, some of the less bearish scenarios out there on the market. Of course, this really started with the Nasdaq and the rotation out of those biotech and those tech stocks. So that continued today. That was the theme today. The healthcare space as well as the information technology space, the two worst sectors on the market, down by more than 2%. But if we have a look across the market, it was broad-based selling today. If we have a look at the top 20 blue chips on the market, not one of them managed a gain today. If we have a look at the top 50 blue chips on the market, only one managed a gain today. And if we have a look at the top 200 stocks on the market, we saw 16 stocks rising today. So it was red across the board. As you can imagine, it was those stocks which are considered high growth, which did see the biggest falls. And we've been concentrating on zero for a whole week now. Today, another bad day, down 6.6%. Not only that, the heavy falls that we've seen in international markets means that we're seeing fund managers coming under pressure as well. Magellan Financial Group was down 6% today. We also saw BT Investments down more than 5%. Henderson Group was down around about 5% as well. We did see some moves into the defensives, but in the end, Telstra even ended flat. That did see some support during the day. But commodities are faring pretty well today, and I guess seeing individual stocks doing well. We've seen nickel prices at 13-month highs, so some of the nickel producers doing well today. And we also saw that big sale of Glencore's copper mine for $5.9 billion to China's Minmetals. So that seemed to help Oz Minerals, which was up by around about 3%. But all in all, a pretty horrific day for the Australian share market, and we've fared pretty well up till now. And also technically an important area as well. If we have a look at last week, we were talking about a dead cat bounce. It does now look like last week was a dead cat bounce, and that 61.8% Fibonacci level that we did manage to breach looks like a false breach. In terms of the US stock market, this is the Nasdaq. You can see that we've already gone past the yellow line, which is the 50-day moving average. We're below the green line, which is the 100-day moving average, and now we're challenging the 200-day moving average. The Australian market's very different. If we have a look at the Australian market in the past year, this is what it looks like. And today is significant because we've just managed to breach that yellow line, which is the 50-day moving average, and we've done it on the close. If we have a look at the intraday graph, you can see that closing auction, 5,363 points. We're below that mark at the moment, so not looking too good technically for the Aussie market either. We will see a correction of around about 5 to 10%, and people are just waiting for things to bottom out. And in regards to the money managers, you know, they do well when the market goes up because they see higher inflows, performance fees come into the picture, and funds under management go up. When the market's going down, we see the opposite. We see fund outflows, and we see funds under management going down. And it's particularly those international fund managers like Magellan Financial Group and Henderson Group, which are being sold down heavily at the moment. Now, if we do start seeing that stemming in terms of the US stock market performance, then we will start to see a lot more support for these stocks. But at the moment, we are seeing a move to the defensives, and that means we are seeing areas like the telecom, utilities, the areas that are outperforming. Also, that sell in May and go away. I guess one of the reasons that might work on the Australian market is that 3 out of the 4 big banks go ex-dividend in May, and usually we do see a bit of outperformance by those banks ahead of that ex-dividend date. So ANZ, NAB and Westpac, but we saw no sign of that today. We did see those big 4 banks being sold off after that weaker than expected JP Morgan result out on Friday, and this week's going to be a big one in terms of earnings season and financials in the US. So just watching those big 4 banks, especially those 3 going ex-dividend in May, because usually we do see a bit of support up to that ex-dividend date. Unfortunately, I think investors have been tarred by QBE in both 2012 and 2013, so I'm very wary of this stock in 2014, and I have to agree about the Winterthur business. Gross written premiums of about $1.5 billion, now around about $900 $100 million. They're involved in property as well as casualty insurance. So the fact that the market thinks that we're going to see some more losses related to this particular business in North America, not good news for QBE. I think the view was that, you know, the bad news was out of the way, and if we're going to see bad news trickle through again, that's really going to have a negative sentiment in terms of QBE's share price, and we did see the shares reaching a 7-week low today.